Hi, I'm Ryan Lightfoot-Brown, Research Analyst at Chelsea Financial Services. We're joined today by Gary Kirk, Fund Manager of the 24 Dynamic Bond Fund that features on our selection and our core selection. Hi Gary.
Hi, good afternoon.
Gary, we last met you on the morning of the US election and Trump's victory. The bond market had a very muted response that day. What's happened since?
Well, indeed, I remember that morning particularly well, and I think the markets, pretty much like very many other areas of society, I think there was a bit of a state of shock actually when the result came through. Even though in the polls leading up to the final election were pretty close, and it was difficult to call, I don't think anybody really believed he was actually going to win when it happened. And there was an initial muted response. I think we met in the morning of that 9th of November. But the markets did actually sort of move pretty rapidly afterwards. I mean, on the actual day of the election, on that Tuesday, which was the 8th of November, 10-year treasuries, which are pretty much the sort of the key benchmark bond, were around 1.85% yield. Now, that was on the Tuesday. By the end of that week, on the Friday, they'd just about breached 2%. So a reasonable move. Within a week, they were trading up at 226. So for a Treasury bond market, that's actually quite a reasonable move in a short period of time. A 4-point move in the Treasury, just to sort of give you some kind of flavour of how that actually impacts investors. The actual break even, i.e., how long it would take you to actually, for the income from that bond, to repay that particular capital loss at that time, that 4 points, would be about 1 year, 9 months. So it's actually quite a considerable move, for what's supposed to be a risk-off product. Bearing in mind, within March of that year, or March following that year, they moved up to 263, and that would have actually taken best part of 2.5 years or so thereabouts to get to break even. So there was actually quite a move, but it took a little bit of time before I think the market thought about the ramifications of that particular result. Of course, that was off the back of Donald Trump promising to deploy an unprecedented fiscal stimulus package. US Treasuries obviously reacted there to the potential of the inflationary impact of such legislation. But of course, on the flip side of that, where we sit, credit, what did that fiscal stimulus do? It actually, promised to sort of extend the credit cycle, which at that point was already, beginning to sort of show signs of actually becoming a mature phase. So it was good for credit, but it just meant that the government market became that much more fickle, that much more volatile, and that much more difficult to actually be positioned in. Okay. Since then, of course, the honeymoon period. Has he got the legislation through that he wanted? No. Although it's looking like maybe he might get a few tax sort of changes through now. That, along with Janet Yellen's being a little bit more sort of hawkish as well, we have seen it sort of in the last month move from 2 to 2.32%. So it's been volatile. The credit markets, though, have actually been relatively benign and have enjoyed a pretty good run because people just see that the credit cycle could be extended.
Okay. At the time, you mentioned that central bank policy is more important than politics when it comes to the bond market. We've had 3 interest rate rises since you last came in, potentially one later this year. How are the markets reacting to this?
Absolutely right. Central bank policy is the most critical factor for bond markets, full stop. It sets the tone, it sets the momentum for the markets. Elections, other geopolitical events, they may have short-term impacts on market, but it's central bank policy that really does drive market momentum. So that's absolutely critical. The good thing is that the key central banks, the Bank of England, I would include in that, the ECB, and of course the Fed, have been particularly good over the last few years in their forward guidance, guiding the market, which of course does actually help reduce and minimise the element of surprise which markets don't like. So that's a really, really positive thing. Now at the moment, the market is expecting further interest rate rises. I looked this morning before I came over, and it's predicting a 70% probability of a Fed hike before the year end. And in the UK, for gilts, there's a probability of 80%. which of course is just that reversal of the emergency rate cut that Carney imposed in the aftermath of the UK referendum. So, how much of this is already priced in? Those percentage probabilities, give us an indication that quite a considerable amount, and we've had a lot of forward guidance, so therefore a lot of it already priced in. I don't think we're really going to expect to see too much dislocation in the markets after these rate rises, if indeed they do take place, around December, which is when most people expect them to be implicated.
Your dynamic bond fund has a fully flexible mandate. Where are you seeing the opportunities in the market at the moment?
You're right. We can be flexible. We can move across all areas of the fixed income world. At this stage of the cycle, I think most people sort of realise that we are becoming sort of late, more mature sort of cycle phase. And so therefore it is always nice to have a balance in the portfolio, some negative correlation to credits, and typically that would be the risk-off trades would be in US Treasuries or gilts or bonds. Now, at the moment, those government markets, because of the interest rate rises and we are in a tightening phase, they just look like the wrong value at the moment for that risk-off trade. So in terms of our negatively correlated favoured trade, we're actually involved in the Australian government market at the moment, not because we think there's a capital gain to be had there, but we just believe that the Australian government market still is negatively correlated to credit. It still has some contagion for that flight to sort of the quality, that flight to safety haven. Philip Rowe, the head of the RBA, the Royal Bank of Australia, has mentioned recently that while he still expects the Australian economy to pick up over the next couple of years, wages remain below the bank's estimate for full employment, suggesting that policy action in Australia is somewhat behind the rest of the established economies. And only today, the latest retail sales data that came out of Australia was really weak. It actually came in at 0.6 negative as opposed to 0.3 positive. So that kind of supports that on hold policy for Australia. So that's our risk off trade that we prefer. Our risk on favoured sector remains bank capital, and for those of investors that have followed this fund will know that that's been a firm favourite of ours for a few years. It remains that way, and there are 4 very, very good simple reasons why we support this view still. Fundamental improvement in the banking sector. The credit metrics have improved dramatically. If you look at leverage, if you look at non-performing loan ratios, they look much healthier than they've been for an awful long time. The maturity of the sector, the new structures were actually introduced in 2013 in the aftermath of the financial crisis. In those early days, those structures weren't particularly well known. They were the domain of the hedge funds. Since then, a much wider, broader investor base have actually been involved. So therefore, the technicals are that much stronger now for the AT1 and deeply subordinated bonds in the financial sector, which we obviously is a positive, which we like. The regulation has been, far and wide. It's been very deep. It's been imposed to increase the transparency of the banks. It's improved the buffer capital, so they're safer from an investor point of view and from a taxpayer's point of view. And finally, and quite simply, in terms of valuations, investing in deeply subordinated bank paper, you get rewarded for that complexity premium. And compared to virtually every other area of plain vanilla fixed income bonds, they stand out as still having the most attractive yields and attractive spreads. So for that reason, we maintain that they are still worthy of position in the portfolio.
Okay, well, Gary, that's been really interesting. Thank you very much for coming in. Thank you very much for watching. Goodbye.
Thank you.